Most people in the UK are paying tax they don't have to pay, not because of anything complicated, not because they've done anything wrong, just because nobody ever told them about one account that makes a significant chunk of their investment returns completely untouchable by HMRC. We're talking about an ISA, and if you don't have one, or you have one but you're not using it properly, this episode is for you. Welcome back to the Investor Center podcast. I'm Isiah. Today we're breaking down the ISA, what it is, why the stocks and shares version is one of the most powerful tools available to ordinary investors in the UK, and what you should actually do with it. Before we get into it, if you're looking for the best sign-up deals with FCA-regulated UK investing platforms, head to theinvestorcentre.co.uk. Everything is linked in the description. Let's begin. ISA stands for Individual Savings Account. The government gives every UK adult an annual allowance, currently £20,000, that you can put into an ISA each tax year. Any growth, any dividends, any interest that happens inside that account is completely free from capital gains tax and income tax. You don't declare it, you don't pay tax on it when you withdraw it. It just grows and it's yours. There are a few different types. There's the cash ISA, which works like a savings account, the lifetime ISA, which is designed for buying your first home or for retirement, the junior ISA for children, and the stocks and shares ISA, which is the one we're focusing on today, because for most people who want to build wealth over the long term, it's the one that matters most. A cash ISA protects your interest from tax, and that's useful. But with interest rates where they are, you're fighting inflation at best. A stocks and shares ISA lets you invest in funds, shares, and ETFs inside that same tax-free wrapper. And historically, the stock market has returned somewhere between 7 and 10% per year on average over the long term, after inflation is accounted for. That's a very different conversation to a savings account. The tax-free part matters more than people realise. Outside of an ISA, if your investment grows and you sell them, you may owe capital gains tax on the profit. If you hold dividend-paying stocks or funds, you may owe income tax on those payments. Inside an ISA, none of that applies. The account is a shield, and the longer you use it, the more powerful that shield becomes. Just a quick one from us. If you're ready to open a stocks and shares ISA, we've compared the best platforms available in the UK right now, including some genuinely good sign-up offers. The link is down in the description. Go check that out and we'll get straight back into it. Here's where it gets real. These are illustrative numbers, not a prediction or a guarantee of returns, but they show the direction of travel clearly. Let's say you invest £500 a month into a stocks and shares ISA. That's £6,000 a year, well within the £20,000 allowance. You invest in a broad global index fund. Historically, global markets have returned around 7% per year on average over the long term. Past performance does not guarantee future results, but we're using that as a working figure here. You leave it alone for 30 years. At the end of those 30 years, you'd have contributed £180,000 of your own money. But the total value of the account, roughly £600,000. The extra £420,000 is entirely the result of compounding returns over time, and every single penny of that growth inside an ISA is tax-free. Now run the same scenario outside of an ISA. In a standard general investment account, the growth is the same, but when you come to access it, you'd be looking at a capital gains tax bill on a significant portion of that £420,000 of profit. At current rates, higher rate taxpayers pay 24% capital gains tax on investment gains. The ISA doesn't just save you a few £100. Over decades, it can save you tens of thousands. One thing that catches people out every year, the £20,000 ISA allowance does not roll over. The tax year ends on the 5th of April. Whatever you haven't used by then is gone. You can't carry it forward. You can't add it to next year's allowance. It just disappears. That doesn't mean you need to rush and invest £20,000 today. Most people don't. But it does mean that if you've been thinking about opening an ISA or adding to one, the clock is always running. And every year you leave it, you're giving up a year of tax-free compounding that you can never get back. So here's what it looks like in practice. What we'd be doing is opening a stocks and shares ISA with a platform we're comfortable with, picking a simple, low-cost global index fund, and setting up a direct debit for whatever amount makes sense each month. And then doing what Grace Groner did. If you caught one of our previous episodes, you'll know exactly who she is, leaving it alone, not checking it every day, not panicking when markets drop, just letting time and compounding do the work inside a wrapper that HMRC cannot touch. The account exists, the allowance is there. The only thing standing between most people and using it is not knowing it's an option. But now you know. That's it for this episode. This is not financial advice, it's just information, and we hope it was useful. If you want to explore ISA platforms, the comparison links are in the description. Make sure you're subscribed or following so you don't miss the next one. I'm Isiah from the Investor Centre, and we'll see you in the next one.